Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. As we continue on our coverage in the silver market, and certainly an interesting time right now in particular as the COMEX May silver deliveries, first notice day, is coming up tonight. And, of course, we have the interesting action on the LBMA where they revealed that last time silver squeeze went down, they were weeks away from running out of metal. Which certainly seems to be different than what many of the bullion bankers say. But to break it all down, joining me live on the line, not only the sharpest silver analyst in the Northern Hemisphere, but dominating the South as well, is Dave Kranzler of Investment Research Dynamics. Dave, welcome on in, and how are you doing tonight, sir?
Well, thanks for having me back on. I'm doing okay. There's probably people out there who would disagree that I'm one of the sharpest silver analysts in the northern and southern hemispheres, but I can say that I've studied it, researched it, invested in it, and traded it for quite some time, so I know a little bit about it.
Yeah, and plus anybody would say something so silly. I hear that's what they call a Keynesian treasury investor, and I don't know, at least as rumor goes. I don't know if they're real people anyway, so we'll leave them aside and talk to the legion of silver fans who are always interested to hear what Denver Dave is seeing. Golden Dave, actually, if we're going to be completely accurate about it. But neither case, with everything that's happened in the past 3 months, where do you see the situation with the deliveries? And we have seen metal leave the COMEX. Where do you think we stand?
It's a good question. One thing that I've learned over the last 20 years is that what's really going on at the wholesale level, when I say wholesale, I mean what the bullion banks are really doing, has been made intentionally opaque. And, every time they say they're going to reform their reporting, and make it more transparent, it becomes even more opaque. And the best example is when the LBMA restructured their fixed process and said they were going to make the data more readily available and more transparent, and they actually did just the opposite. So, all we can do is kind of guesstimate based on, the indications that we're seeing in the marketplace. And obviously, starting last March, the situation with physical gold started to become very tight, and it looks like really since probably December, January, it looks like the silver situation has also become tight. And clearly the mints are on allocation, and there's a lot more silver demand, especially at the retail level, than there is supply right now. And that's why premiums are so wide. And that basically tells us that the mints have been somewhat cut off from supply, or at least enough supply to fulfill retail demand, because that silver is needed elsewhere to make physical deliveries to, non-friendly buyers who won't be as patient as the retail market will be. So, I think there's generally at every level, there's probably a lot more demand than there is supply. And, another signal that we're seeing is the intense effort right now in the paper market, the gold and silver derivative markets to hold down the price. And one of the motives for them doing that is to try and discourage people from getting interested in investing in people and institutions from buying and investing in gold and silver. And what struck me this time around is that this manipulation in via the derivative markets has been going on now for several weeks, and it just seems that it's antagonizing and pissing off the retail side anyway, at least even more so, and there's even more resolve to try and create some type of short squeeze and expose the truth about what's really going on.
Yeah, and Dave, it's interesting because you mentioned how these institutions, they're set up and say that they're giving transparency and full information on the market, and then in reality, it's often quite the opposite. And if the ones you mentioned are fit that pattern, I'm curious if you have heard the recent comments of CFTC Acting Commissioner Ralston Benham. This is the guy that on February 1st launched a silver manipulation investigation. Then on February 2nd, we had what I would call the biggest silver manipulation occurrence in the history of silver, which is not an easy title to wrest away. And then Benham gives these comments saying that, the market structure really was tamped down what could have been a worse situation, and that, they acted to control the price and volatility. Curious if you have any thoughts on that. I've never imagined I would hear a regulator say that in my entire financial career. I was stunned by it. Is there any other possible meaning that you could think of that might – is there any way you could explain those other than price capping? Or what do you think about that?
I did. I mean, you've done a great job exposing these scoundrels and exposing Benham's comments there, and it really is kind of stunning because it's really an overt admission that they're they manipulated the market. And when he says contain the volatility, well, markets by nature are volatile, and you need to let them be volatile because that's how the price discovery process works, is through volatility. And quite frankly, the CFTC's jurisdiction is the commodities markets and the gold and silver futures markets. So to the extent that he basically de facto admitted that they intervened and manipulated the market, he's specifically referring to the paper derivative markets of gold and silver on the COMEX. And there's no other way to interpret what he said is other than they intentionally capped the market. And that's another one of these indicators that would suggest that the real supply of physical silver and gold, and not just what they're reporting in the daily warehouse stock reports, but the real supply of deliverable metal is becoming a lot more scarce. And I think they're worried about it.
Well, I'll take that a step further. I don't think it's becoming more scarce. The LBMA flat out told us they were weeks away from running out of metal. And I can understand, on one hand, I think I know exactly what Benham meant. I think he said quite clearly. But what I don't get is that, Craig Hemke mentioned the price gets hammered down. It got hammered 10 years ago today. It was at $50, and when it opens Sunday night, gets hammered down $6. There's no fear there. When the stock market is soaring to new all-time highs, despite, CNBC tells me that COVID's the worst thing ever, and that infections are up, but the stock market never goes down. Lumber is soaring. Lumber, I think I found it's like a six-bagger in the last year. So why is it that all of these other markets, the price is allowed to go up or down, but if the silver price goes up, that's Armageddon, as confirmed by the CFTC commissioner? Why can't, if people were buying, why wouldn't the price go up? And it's almost like he's saying if people bought so much metal, the LBMA was about to run out, but by the end of February 2nd, the price was actually lower than before this all began, January 28th, then Dave, I ask you, what are the conditions in which the silver price could go up? Or is it just capped at $30 and no matter what happens, the CFTC is going to make sure it never goes through that level? What else am I supposed to take away?
No, at some point there will become enough stress on the physical side of the market that it's going to force the issue, or there's also always the possibility, and I think it was a combination of both back in 2011 that drove the market higher, and drove silver up to almost 50 and drove gold up to 1900. And that is, a shortage of physical supply, but also a short squeeze that started happening in the paper markets. And that could happen again if the bullion banks are too far over their skis in terms of their net short position, and all of a sudden you get a bunch of hedge funds jumping into the market and CTAs chasing momentum higher. I mean, that's kind of a lethal combination there, where you've got a paper short squeeze and a physical short squeeze, and I think that's a large part of what we saw in 2011. Now, if you'll notice, back then the price of gold actually didn't peak until September that year, whereas silver peaked, as you pointed out, in April. And J.P. Morgan apparently was staring into the abyss with their short position back then, and I think they basically threw, in conjunction with the other bullion banks and probably the Federal Reserve, they threw a Hail Mary by dumping a boatload of paper into the market. And at that point, after silver had a parabolic run up, I'm sure the hedge funds had plenty of stop losses that were triggered, every 50 cents of the way on the way down, and that exacerbated the problem. So no, I don't think they'll be able to hold silver below 30, and I don't think they'll be able to hold gold below 2,000. Ad infinitum. I just can't tell you when I think when gold and silver will break through those two price barriers and what the catalyst will be. But rest assured it will happen. I mean, let's look at it this way: over the last 20 years, we've gone from $4 to $26 on silver and as high as $49, and we've gone from $250 on gold as high as $2,100, and we're now at knocking on the door of $1,800 again. So rest assured, at some point there will be some catalysts that are going to drive gold and silver quite a bit higher, and it'll be a manic move. And I think anyone who's short when that happens is gonna feel a lot of pain.
Yeah, especially that was another thing I found interesting about the LBMA report. They even talked about how during that early part of February, the bank's risk managers were pretty scared, so they told their traders to rein it in, and as soon as the paper supply came in, then, geez, look, the price rose. The things they admitted in there were incredible. Yet, Dave, when you talk about a potential catalyst, last question before we wrap up today. There's a lot of folks, as we come up on the 10-year anniversary of that $6 smash down from 50, that have been talking about, I guess you could call it silver squeeze round 2. I do think it's interesting because the first time it happened, Wall Street silver didn't even exist. Now you have a little experience. People can scale things. Any expectations, or is that not to say that it will be, but is that the kind of thing that does have the potential to be a spark?
Absolutely. I mean, again, I'm not sure that the squeeze will occur, from the retail side, meaning, from the mints, because obviously the mints have had their supply to a large extent cut off. And I just want to point out, I think that's probably the supply that should have been going through the retail distribution network, and it was rechanneled to refill not refill it, but to help ease the problem that the LBMA publicly acknowledged. So I do think it feels like there's more investors, whether it's retail, high net worth, or institutional, that are looking to take delivery from the COMEX, because obviously, if you buy coins through a coin dealer, you're paying a $7, $8, $9 premium over spot for 1 ounce silver coins. But if you go onto the COMEX and take delivery and remove your bars from the COMEX, that's very important, to remove the bars from the COMEX vaults and move them into private vault storage or your own personal storage in any kind of secure storage setup that is not in any way related to COMEX vaults. So not only do they not have those bars available to quote unquote redeliver to people standing for delivery, but they can't count those bars as part of their eligible inventory, which is what they do. Even if they even know, per Ronan's brilliant research that he came up with, and in an article, several months ago. The COMEX counts bars that aren't even available, and they don't know whether they would ever be available. They count that as part of their inventory. So, I do think that, yourself and Wall Street Silver and everyone else who's been involved in making the situation and making the public more aware of the situation, at least those who are paying attention, I do actually think that that's a potential catalyst down the road for driving a vicious short squeeze on the paper side and the physical side.
Well, don't forget, Jeffrey Christian of CPM Group is even a long-term silver bull, so you toss that in there, and there's a real powder keg. Dave, sure appreciate you joining me tonight, giving some updates. Before we wrap up, can you give folks the website address where they can get the Mining Stock Journal, which I believe new episode out today, and also the Short Sellers Journal?
Absolutely. There's links to both newsletters at investmentresearchdynamics.com, and you can just click on the link and get more information about how everything works and what the cost is. And you're right, I did release a new issue of the Mining Stock Journal today, and one of the highlight features is an analysis of the Fortuna Silver Roxgold merger. And Fortuna Silver has been a perennial silver bug stock investor favorite. And I break that down and explain whether I think the merger makes sense or not, and whether Fortuna, after the 23-24% price hit it's had since Monday, has created a buying opportunity, or you should still avoid it. And I also profile Reyna Silver as a potential investment in this issue.
Well, I'll look forward to digging into that one because, again, I've met the folks from Fortuna and Reyna, actually one of the sponsors to the show. They'll be coming up next Monday on the show, I believe. So anyway, folks, you can go to investmentresearchdynamics.com to get the Mining Stock Journal. And fortunately, Dave gives some free commentary there as well. So with that said, Dave, I appreciate you being here. And it's too bad people can't see you point to the subscription button and the notification bell, but go ahead and hit those. That way, when Dave joins me again, you'll be the first to know. And I'm going to say goodbye to you, Dave. But for everybody watching at home, thanks for being here. And if you'd like a little more insight into what actually happened with the announcements from the LBMA and the CFTC, well, that is coming your way now.